Actually, looking at the close today, it's the silence that bothers me more than the number. We saw the Shanghai fix come in at 28,346 yuan. That converts to a premium over London of $17. 17. You don't see that. In a functioning market, you see cents, maybe 50 cents if a vault is locked. But $17 isn't the spread, it's a wall. And usually when you see a dislocation like that, when you see an asset trading at a 40% premium in one city versus another, the arbitrage bots step in. That's how the machine works. That's how it's supposed to work. New York sells paper, buys physical, ships it east, pockets the difference, and the gap closes before lunch. But the gap isn't closing. It's widening. It was 14 on Monday, it's 17 today. That tells you something is mechanically broken in the plumbing. It tells you the metal isn't moving. I've been watching these flows for 20 years, and I've seen squeezes. I saw the Hunt Brothers ghost in 2011. I saw the COVID crunch in 2020. This feels different. It feels permanent. It feels like the West has lost the ability to set the price, and the East has stopped caring what the COMEX screen says. You have to understand, this isn't about inflation. It's not about the Fed pivoting or whatever the headline is this week. This is about physical delivery failure. When you have a $17 incentive to move metal and you still can't move it, that implies the vaults are empty. Not low, empty. At least empty of anything that can be delivered without breaking a lease agreement. There's a chart I'm going to get to in a minute. It's the Shanghai inventory data versus the London vault holdings. And when you overlay them, it looks like a heart attack. One line goes vertical, the other flatlines. And nobody is reporting it. You turn on the financial news, they're talking about tech earnings. Meanwhile, the single most critical industrial metal for the energy transition just effectively split into two separate currencies. If you're holding paper silver, SLV, futures, unallocated pool accounts, you're looking at that screen price of 28 or 30 bucks and thinking you're fine. You're not. You're holding a claim on a ghost. The real price is being set in yuan in a warehouse in Shanghai. And right now, that price is screaming that there is no supply left. It's uncomfortable to look at, it really is, because if this $17 gap holds for another week, the entire futures market becomes irrelevant. It becomes a side bet. And the consequences of that, well, they ripple out way further than just your portfolio. We're talking about the failure of the dollar-based pricing mechanism itself. So I want to walk you through exactly what happened on January 29th, why the arbitrage desk at your bank is likely panicked right now, and why this specific export ban from China, which almost no one read, changes the math forever. Just don't look away from that $17 number. It's the only thing that matters right now. So let's talk about who is actually naked when the tide goes out here, because the narrative you're being fed that silver is just a volatile commodity responding to risk-on or risk-off flows is a dangerous simplification. It assumes the market is symmetrical. It assumes for every buyer there is a seller, and the price is just the equilibrium. That is false. The market right now is asymmetrical. You have a massive concentration of paper shorts, mostly Western bullion banks, and a fragmented, insatiable base of physical buyers in the East who stopped caring about the paper price 3 weeks ago. The entities most exposed here aren't the miners. They're fine. They're actually the only ones sleeping well. The exposure sits with the clearing members of the COMEX, who are holding short positions against inventory that, frankly, I don't think is there. And I'm not saying that as a conspiracy theorist. I'm saying that because I can read a warehouse report. Here is the first hard data point you need to burn into your brain. In the first 3 weeks of January alone, 33 million ounces of silver left the COMEX registered vaults. Registered just means the metal that is fully warranted and available for delivery against a futures contract. It didn't just move from one vault to another. It left the system. It was loadout. That is a 26% reduction in deliverable supply in under a month. If you saw Amazon's warehouse inventory drop 26% in 3 weeks, you'd assume they were going out of business, or they had the best sales quarter in history. Here, the price went down during that drain. That is a contradiction. That is the lie. How do you have record demand, verified by the physical loadouts, and falling prices? You have it because the paper market is diluting the pool. The open interest, the total number of betting slips, expanded while the actual pile of chips on the table shrank. This works fine when everyone is just trading slips. It works fine until someone wants their chips. And that is exactly what Shanghai is doing. They are cashing out. Actually, there's a nuance here that most people miss regarding eligible versus registered. You'll hear analysts say, oh, but there's plenty of eligible silver, almost 200 million ounces. Sure, but eligible just means it fits the purity standard. It doesn't mean it's for sale. That could be and likely is Warren Buffett's silver, or a family office's strategic hold, or Apple's inventory. It is not available to rescue a short seller unless the owner decides to sell. And why would they sell now when the Shanghai premium is offering them $17 more than the COMEX spot price? They wouldn't. They'd ship it to China. This is where the export ban changes the calculus. On January 1st, Beijing didn't just tweak a tariff, they reclassified silver export licenses. Effectively, once silver enters China, it is trapped. It's a Hotel California market. This matters because it breaks the loop. In the past, if Shanghai got too expensive, metal would flow in, the price would drop, and eventually some might flow back out if the West got expensive. Now, it's a one-way valve. The drain on the West is permanent. Every bar that leaves a London vault for a Shanghai refinery is gone from the Western financial system forever. It ceases to be a financial asset and becomes an industrial component. And this brings me to the second data point that signals we are late in the cycle: the lease rates. I mentioned them briefly before, but let's look at the 1-month LIBOR-based silver lease rate. It just hit 8%, annualized. To put that in perspective, you usually get paid to store silver. Now you have to pay 8% just to borrow it for a month. That is the market screaming shortage. Banks don't pay 8% to borrow a rock unless they are terrified of failing a delivery obligation. So you have shrinking inventory, rising lease rates, and a severed arbitrage loop. But the mainstream financial press is still writing articles about the Fed's dot plot. It's incredible. It's like worrying about the rain when the dam has already burst. And here's the part that really worries me, or excites me depending on which side of the trade you're on. The shorts, these big institutional players, they aren't stupid. They know this data better than we do. So why aren't they covering? Why aren't they buying back their positions and letting the price rip? Because they can't. The position is too big. If they try to buy back 50 million ounces of shorts in a market with only 30 million ounces of registered inventory, they trigger the very explosion they are trying to prevent. They're trapped in a room with a tiger, and their only strategy is to stand perfectly still and hope the tiger isn't hungry. But the tiger is hungry, and the tiger is the Chinese industrial complex. This disconnect, this gap between the official price and the real price can last longer than you think, but it resolves in one of two ways. Either the physical premium collapses because suddenly supply floods to market, which, given the mining grades I'll touch on later, is impossible, or the paper price has to violently re-rate higher to match reality. There is no middle ground. The $17 spread is the tension in the rubber band. It's stretched as far as it can go. In a minute, I'm going to show you the specific mechanism of how this cash settlement event triggers, because there's a clause in the COMEX rulebook that most traders have never read, and it is the trap door that drops you to zero. But first, you have to understand why the authorized participants, the guys who run the ETFs, are quietly changing their custodial agreements. They see it coming too. So how does this actually break? Because markets don't just explode, they seize up first. The mechanism you need to understand, the one that is currently seizing, is called Exchange for Physical, or EFP. This is the bridge that connects the paper world in London and New York to the real world. Normally, EFP is boring. It's a swap. A bank holds a futures contract in New York but needs metal in London or vice versa, so they swap the positions. It's the grease that keeps the global price uniform. But right now, the EFP market has turned into a graveyard. Traders are reporting that bids for EFP have effectively vanished. Why? Because to execute an EFP, someone has to be willing to take the paper and give up the metal. And nobody, absolutely nobody, wants to give up metal right now for a promise that settles in March. This is why the spread is $17. It's not just a number, it's the cost of risk. It's the market saying, I will not trade a real bar for a paper contract unless you pay me a 40% premium to take on the counterparty risk. The bridge is out. The West is stranded on Paper Island, and the East is hoarding the boats. But there is a quieter signal that I think is even more dangerous, and almost no one is reading the footnotes. The authorized participants, the APs. These are the only entities allowed to create or redeem shares of the major silver ETFs. We're talking about the big boys, JP Morgan, HSBC, Scotia. In the last few weeks, we've seen subtle shifts in the custodial language regarding force majeure and settlement delays. They are quietly expanding the definitions of what constitutes a delivery failure. Think about that. If you run a casino and you know the house is about to lose, what do? You don't close the doors. That causes a panic. You just change the rules on the back of the ticket. They are preparing the legal framework to tell you, sorry, we can't give you the silver because of unforeseen supply chain disruptions, so here's a check for the closing price on Friday. And that is the trap. If you're holding SLV or any unallocated account, you think you have a claim on silver. You don't. You have a claim on a liability of a bank. And if that bank decides it is essentially illegal or impossible to source the metal due to the Chinese export ban, they will legally wash you out in cash. You will get your $30 and you will watch the real price go to $100, and there will be nothing you can do about it. Now, I need to pause here. I need to be honest with you. There is a scenario where I am wrong. There is a way this thesis dies, and I want you to know what it is so you aren't trading blind. If we wake up tomorrow and the global economy drives off a cliff, I'm talking a massive deflationary credit shock where industrial production stops cold, then this squeeze is over. If factories in China stop building solar panels because nobody's buying electricity, then that $17 premium evaporates. Silver is an industrial metal first. If the industry dies, the demand dies. We saw it in 2008. The price crashed because liquidity dried up. Also, there is always the chance of hidden supply. We don't know what's in the strategic stockpiles of the PLA. If Beijing decides to flood the market to stabilize prices, they could crush this premium in an afternoon. I don't think they will because why would they bail out the West? But it's a non-zero risk. If you are betting the farm on this, you are betting that China stays greedy. But assuming the world doesn't end and China doesn't suddenly become charitable, we're left with two paths. A is the 1980 melt-up. The shorts panic, they lift the offer, and we see vertical price action. $5, $10 a day, until the price is so high that people start melting down their grandmother's silverware to sell it. Path B is the exchange failure. This is the darker path. This is where the COMEX declares a liquidation-only order. They tell you you can sell, but you can't buy. They force a settlement price, clear the board, and essentially reset the game. In that scenario, the paper market dies, and the physical market goes underground. We are already seeing signs of Path B. The EFP failure is the first step. The next step is the cash settlement notices. And once those start going out to the big industrial users, the game is up. They will panic buy everything that isn't bolted down. So how do we position for this? Because if you buy the wrong thing, you get cashed out. If you buy the right thing, you become the liquidity. In the next part, I'm going to lay out the specific scenario tree, what happens when the margin clerks make the call, and why the mining stocks might not react the way you think they will. So here is the map. If you are sitting there trying to figure out how to play this without getting your face ripped off, you have to think in terms of scenarios, not predictions. Predictions are for fools. Scenarios are for survivors. The first scenario, and honestly the most likely one for the next 30 days, is the margin flush. I touched on this earlier, but I need to drill it in because it is the widowmaker. The exchange sees the volatility. They see the $17 spread. They know they are losing control. So the CME raises margin requirements overnight. They might double them. Suddenly, every leveraged long in New York gets a call. Post more cash or we sell you out. They don't have the cash. The computer sells. In this scenario, you will see the paper price, the number on your screen, drop like a stone. It could fall $5 in a session, and you will feel sick. You will look at your account and think the thesis is broken. But look at the physical dealers. In a margin flush, the spot price drops, but the physical premium explodes. Spot goes to 22, but to buy a coin, you still pay 40. If you see that divergence, paper crashing, physical premiums rising, do not sell. That is the final shakeout. That's the banks transferring your position to their balance sheet before the revaluation. The second scenario is the force majeure. This is where the COMEX breaks. We get a failure to deliver on a major contract month, maybe March, maybe May. The exchange announces that due to extraordinary circumstances, contracts will be settled in cash at a fixed price. This is the moment the paper market effectively dies. The price of silver in the futures market becomes irrelevant, stuck at, say, $35, while the real trading moves entirely to Shanghai or direct peer-to-peer markets where the price discovers itself at triple digits. If this happens, God help you if you are in a derivative. You will be cashed out at the low price while the asset runs away from you. This is why possession is the only trade that works in a force majeure. If you can't touch it, you're just a creditor to a bankrupt system. Now, about the miners. Everyone asks about the miners. Should I buy the GDX? Should I buy the juniors? It's complicated. In a normal bull market, miners give you leverage. Silver goes up 10%, the miner goes up 20%. But this isn't a normal market. It's an inflationary dislocation. Remember, miners consume energy. They burn diesel, they use cyanide, they use steel. If the price of silver goes up because everything is going up, the miners' costs explode too. Their margins might not expand as much as you think. I am very, very selective with miners right now. I want high grade, I want safe jurisdictions, not places that will nationalize the mine the second the price hits $50, and I want them producing now. I don't care about a drill hole that might become a mine in 2030. 2030 is a different planet. I want metal coming out of the ground today. So here's my personal rules of engagement for this specific crisis. First, I'm watching the Shanghai inventory drawdowns like a hawk every single day. If that curve flattens, if China stops draining the vaults, then the pressure is off and I will reassess. But as long as that line is vertical, I am holding. Second, I am explicitly not using leverage. I know it's tempting. I know the options offer massive returns, but the volatility during a currency fracture is infinite. You can be right about the direction and still get liquidated on a Tuesday because of a random wick down.